Hey everybody, Tyler and I have been doing some buying in the stock market lately. Um, some of my favorite stocks issued their earnings reports and fell afterwards, despite the fact that I still love them long term. So I've been doing a little nibbling here and there. We're going to get into some of the stocks we just bought. Before we do, check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from our sponsor, The Motley Fool. It's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So I'll start because Tyler has one that you might not have heard of. But for people who want a stock that they're familiar with the company and know what they do and see their products on a day to day basis, that's my job. So the one I just bought and I added to, it's one of my largest positions, is Disney, ticker symbol DIS. And I know it's kind of a controversial play right now because of the streaming business, because their linear entertainment, meaning their TV networks, aren't doing well, things like that. And the parts of the business that are doing really well, like the parks, depend on strong consumer spending, and that's kind of a question mark right now. Um, but Disney just reported its earnings a few weeks ago. The stock went down about 10% right after the report. It missed revenue expectations. It issued weak full year guidance, so really not a surprise that the stock went down. But if you dig into the business, there's a lot to like, and the future looks pretty bright. So the experiences segment, which includes things like the theme parks and the cruise line, revenue was up 10% year over year. That was a very strong number, especially with economic uncertainty going on right now. The entertainment segment was down 5%. I mentioned their TV networks are not doing that well. Advertisers are spending less money because not only is there the uncertain economic climate, but fewer people are watching TV networks, so they're obviously going to spend less money advertising on it. People are canceling traditional TV services like cable and satellite, and it's just not a good environment for that business. And their entertainment segment also includes their film studio, and that was just a real tough year over year comp. One, there were no real blockbusters that Disney released in this quarter, but in the same quarter a year ago, they were still getting the revenue from the Avatar sequel, and it's really that you really can't compete with that. So not a big surprise there. On the streaming side, Disney Plus and Hulu achieved profitability for the first time ever, which one of Bob Iger's biggest the reasons he wanted to take over was to a mission to make the streaming profitable, not just a grow at all costs business. That's on target. Disney's entire streaming business is on track to be profitable by the end of this year. That, of course, includes Disney Plus, Hulu, and ESPN Plus, which currently is losing money. Um, Profit growth is impressive. He's really focusing on efficiency after years of not making money. Disney's revenue was essentially flat year over year. I think it was up 1%. Their adjusted EPS was up by 30%. Free cash flow was 21% higher than it was a year ago, which is really impressive on flat revenue. Um, and in the future, there's a lot of things to like here. Streaming profits is just getting started, in my opinion. Um, Not only is the business becoming more efficient, but Disney continues to add members, and now they're starting to focus on just more, quality over quantity when it comes to content. Disney Plus added 6 million core subscribers in this most recent quarter alone. In the experiences segment, if we're being honest, a lot of their theme parks need a refresh. Um, they're doing a lot of projects right now. That's really going to ramp up. They're planning on investing $60 billion in their experiences segment, mostly in the theme parks, over the next 10-year period. The cruise line, if you're following any Royal Caribbean or Carnival or anything like that, the cruise business has never been doing better. And they're taking delivery of two new ships in the next couple of years, one of which will be their biggest ever. So that's also something else to look forward to. I think there's just a lot of forward catalyst here that the market's not really appreciating. They're growing their profitability very, very quickly. So I think a 20 times multiple on forward earnings is reasonable to pay at these levels. And Disney apparently agrees. really emphasizing buybacks and returning money to shareholders that way this year. They spent $1 billion on buybacks in this quarter alone. Um, and I just think it's a good value at these levels. Not going to make you rich overnight. Not a cool outside the box stock like Tyler's about to talk about, but great all in all value, great brand. Their intellectual property is, beyond comparison with anyone else. So Disney, my one of my largest stock investments and one that I am building on. Tyler, what do you got?
Matt, let's talk about prostate cancer.
Way to kill the mood going from Disney to that.
Does I know, right? It's a gift, really. I have. It's hard to explain. So, a company I just recently purchased actually is a company called Lantheus Holdings. I apologize if I mispronounced it. I've only read it and never actually heard it said. The company has been around for decades. Basically, what they make is radioactive isotopes that are used for medical imaging. So if you go in for what's called nuclear imaging, like PET scans, things like that for thyroid cancer or bladder cancer, or things like that, these have been, you use a radioactive agent and the scanner can actually kind of see how these agents flow through your body. They've been doing this for decades, and it wasn't exactly it's a pretty slow growth business. It's nothing that, anyone would want to write home about. But a couple of years ago, they developed a new radioactive isotope that was specifically designed to bind or give better imaging results for what is called the prostate-specific membrane antigen, which is basically like it's like a type of like protein that is found on prostate cancer cells, not just in the prostate itself, but also if you were to have that specific type of cancer spread across your body. This this imaging agent has basically become revolutionary for the detection of prostate cancer over the past couple of years, and it's become like the go-to thing when it comes to actually doing a proton emission. I always get this wrong. Positron emission tomography, a PET scan. I know we're getting in some fancy words here, but basically it's become like the standard for when you actually want to do one of these particular types of scans for prostate cancer. And as a result, the company has almost it's been like an overnight success, decades in the making. And what we've seen in the past 3 years alone, we've actually seen a quadrupling of revenue, and earnings are up almost 10 to 20x for that they were 4 years ago as a result, because this has been so game changing. I mean, we've talked about a lot of things in previous videos on other topics in healthcare where you have aging population. So prostate cancer is going to be a higher occurrence. And because of that, and when it comes to things like this, insurance tends to pay for a lot of these things, especially Medicare. This was actually approved for Medicare payments because it's been so successful in detecting not just prostate cancer, but also if people go into recurrence or if it starts to metastasize elsewhere. So you have this kind of, it's almost like a blockbuster drug for a biotech, but it just happens to be for an imaging company. And the other thing that's kind of interesting, like this right now is immensely profitable. It's still growing, but they're also working on some really interesting things in the pipeline. I don't give too much credence to these right now because they aren't actually making money. And I think a lot of investors have been burned in the past with like promising things in a medical company's pipeline that never actually do anything eventually. But some of the things that they're thinking about doing is like, hey, we can take this radioisotope, use it as a package with actual like drugs to treat the cancer itself, and maybe we can actually come up with a prostate cancer treatment, which would be huge, obviously, especially when we talk about, again, older population, higher prostate cancer rates. They've also they've been fast-tracked for a late-stage clinical trial for a similar radioactive isotope that is used for targeting the proteins associated with Alzheimer's disease. And so we could also see in the next couple of years a significant upgrade in imaging detection of Alzheimer's, and the possibility of that becoming one of the industry standards for diagnosing Alzheimer's. So we have two basically like diseases that are becoming very, very prevalent with an aging population, and imaging agent, so basically not like actually treating it, but being able to detect it, it to me seems like a very promising idea. Clearly, it's working right now with its prostate cancer detection, and as a result, the earnings are like I said earlier. And at the same time, this is a business right now trading for 12 times earnings. I think not a lot of people are paying attention to it, but they probably should.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.